Good afternoon. Now, many years ago, Martin and I went along to a presentation skills shop and we were told never read the slides. So I'd just like to introduce us for those that we have not met before. We have met a number of you in the room before. I'm co-founder of Mercia, CEO of Mercia, background in life sciences. I still keep portfolio responsibility on a number of our life science assets. Martin will be joining us in a second. Martin, can I ask you to shout out a bit of your background?
I've been with Mark nearly 9 years. I think that's what's more I can say. Thank you.
And it's been a remarkable journey so far. And what we'll do is we'll give a highlight on what we've achieved, where we're going throughout this. Now, never more than ever, based on what's happened in the last few years, is liquidity a key point. And by liquidity, I mean genuinely being able to access your cash in terms of liquidity. We have got approximately 300 million of free cash across the group, and that was ahead of the acquisition of FDC, where our liquidity has gone up, and I'll talk to that in a moment. The nature of the third-party funds we manage, and we're about 1.4 billion under management today, and Martin just talked about the start of our journey, and that's when we had 30 million under management when we started. The nature of the funds we manage, and approximately 1.1 billion, I guess, 1.2 billion are on third-party funds at that 1.4, are they're long-dated funds. What we mean by that, they're typically either evergreen or they're 10 to 12-year funds. So these are funds with some security. We can see both the fee income coming on year, as well as the capital to draw down to support existing portfolio, as well as make new investments. And those that know us, the sorts of businesses we back are businesses with very modest capital needs. Typically, they don't need more than 30 million. We can pretty much do that in the entirety if we had to. We like to syndicate, but that means that in the events of economic turmoil, we can support those portfolio companies that deserve to be supported through our own means. Mercia itself is a sustainable, growing, profitable business, making us resilient as we step forwards back to that sort of structure in terms of our fee income that Martin will talk to later. Our direct investments, and I'll talk about the model in a moment, net asset value per share reflects both our cash and our direct investment activity. That's at 46.8 pence per share, and that is up. And I should say, actually, these are our interim results, so results we presented in December. But we're, of course, happy to take questions around these that is already in the market, should I say. Up from 45.6 pence. So a growing NAV per share basis. And of course, being profitable, we're on a progressive dividend journey. The last dividend was 0.33 pence, our interim dividend, and that itself was a 10% increase. Just on the right side there, we are very much domestic only. We only invest in the UK. We invest across the UK, and we believe you need to be close to those opportunities to originate those deals. You can see we've got 9 offices that swing across the country. We recently opened a Bristol office, which I think is number 6 on there. And importantly, the black one, number 9, is our Birmingham office that we acquired through the acquisition of FDC. Just in terms of the model, we operate a somewhat unique model in terms of using our own balance sheet, proprietary capital, coupled with third-party funds. So the balance sheet capital predominantly is there to either be, on a selective basis, an investor in our funds so that we can accelerate the growth of managed funds. All of our balance sheet investments are co-investments with our managed funds. But to put that into context, we've got something like 250, 300 venture businesses and approximately 20 of those on our balance sheet. So very selective co-investor. And of course, to make acquisitions. The FDC acquisition was a full cash acquisition through our own cash means. What that means is that we do not see a reason today to go back out to the market to raise money. This is a cash generative business now that we're going along. On the other side of that is our third-party funds, profitable operation, very interconnected pools of capital across venture, different stages of venture, private equity and debt, and a very strong connection between those two separate pools of capital, meaning capital growth is driven by our direct investment capacity, and that dividend I was talking about, the yield, is driven by the profitable fund management operation. We've made a number of acquisitions over the journey that Martin alluded to, that 9-year journey. We've made 3 acquisitions, typically 3 years apart, actually. Enterprise Ventures was our move into the north of England, very successful acquisition. The VCT fund management contracts from MVM was then a scaling of venture so that we could do later stage venture investments. And FDC was a move into much larger debt transactions. And those 3 interplay and interconnect really well. The discipline that we operate is what we term the value drive analysis, where we're looking for at least 20 defensible reasons why that business should be part of the Mercia Group, the complementary part of the Mercia Group. And at the very top of that list is cultural fit. Most acquisitions end up destroying shareholder value. We're looking at here to enhance shareholder value, which you can see threading underneath here is it's not just about acquiring third-party funds under management, it's then about the organic growth of the FUM after that. And you can see from those first two, we expect FDC to deliver the same going forwards. Just in terms of the pools of capital we manage, there are three discrete pools. So we manage retail capital, enterprise investment scheme that none of you will be familiar with, EIS, and venture capital trust, VCTs. Our venture capital trust, the Northern VCTs, is currently open at the moment, raising 18 million. That should close in the next week or two. That's a really important pool of capital for us to be managing. 18 million is the VCTs we're raising this year. We'll raise between 25 and 30 in EIS this year in the context of a 1.6 billion EIS market and a 1.1 billion VCT. In other words, we've got much to go after, and actually now we're in the sort of top 3-4 managers in the country, so that is an opportunity for us to grow into that space. We manage a regional amount of the British Business Bank regional funds, the Midlands Engine Investment Fund, the Northern Powerhouse Investment Fund. The next generation of those funds are now coming out in a competitive process. We'll be looking to secure those, a number of those going forwards if we can. But it's important to reflect on the existing funds we have. Back to my point, they're typically 10 to 12-year funds. They're not quite 5 years into their journey. So we still have quite a long time left with the existing funds, but we are looking to, again, build up on those funds. And the final pool of capital we manage is institutional capital, typically regional pension funds, and typically pension funds that are using an impact allocation as they look to sort of do good within the regions. As a regional and national investor, that's a pool of capital that we like to manage. And again, another pool of capital we expect to grow over the near to medium term. This is quite a nice slide that just details the various asset classes that we manage, venture, private equity, debt, and our own balance sheet. And FDC there, Frontier Development Capital, the acquisition back in December, that's obviously part of the debt, but you can see that there sticking out in terms of what it was exactly that we acquired. And what that means is, frankly, we can invest anything on the individual pools between 0.2 and 10 million, but actually when you slot those things together, we're writing checks of up to 20 million now. So, a much more important player in terms of capital provision for the SME base. And in talking about the SME base, we currently have about 550 companies across all of our funds under management. We're one of the most active regional investors now, which is a real pleasing place to be now on this journey. You can see that liquidity going across. I talked about the strength of that, but that has grown, of course, with FDC, just a shade under 460 million now of restricted. So about a third of our assets under management are unrestricted cash. So a very good place to be. That is 2 or 3 years of investment capital should we never raise another fund again, which obviously we will. Martin.
Thanks, Mark. And good evening, everybody. And the first thing I have to say is that none of that money was with Silicon Valley Bank. Just in case anybody was wondering, if HSBC hadn't rescued Silicon Valley Bank UK, it would have had no impact on our portfolio companies and no impact on Mercia, I'm pleased to say. These numbers are sort of slightly old now because they're September, 6 months to September 2022, but they are our most recent numbers. And I guess the headline there is, we're making a healthy profit now of 7.4 million before tax. At September last year, we had 56.1 million, and our net asset value per share, the balance sheet total net assets, 46.8 pence. So from, let's say, as Mark, when we started, we've developed a profitable cash generative business. This slide shows the movements in our assets under management from the beginning of the period that we were reporting, which was from the 1st of April through to the 30th of September. And then the far right-hand column shows you the funds that we had raised after the 30th of September, the biggest number, of course, being the 415 million that FDC was managing at the time that we bought them. And a further 12 million was raised of EIS capital after the period end. And I think what this reflects is sort of, in a sense, how tough the market has been during the last certainly 12 months for venture businesses, and the negative 21 million there is simply the VCTs largely have one or two AIM companies. Music Magpie you'll have heard of, I'm sure, and that was just reflective of the drop in the share price of Music Magpie. But overall, we had good investor inflows of 54 million, and we paid back 18 million during the 6-month period to our investors as well, across our funds and our balance sheet. So, healthy business. I won't try not to bore you too much with this. This was our sort of consolidated income statement for the 6 months under what's called International Financial Reporting Standards. So 12 million of revenues, an operating profit of just under 6 million. Very healthy finance income, which is a combination of bank interest, which is now obviously growing. We're now earning on we spread our money across, if any of you that saw our announcement yesterday morning at 7 o'clock on how we spread our money across 4 UK banks. And we're now beginning to earn a reasonable rate of interest on, quite a lot of money, which is good. And we've used up all our tax losses, as you may have heard me say in the past, so we are now paying some corporation tax, sadly. The day before we floated all those years ago, I think our balance sheet was £10 million, and now we're at the half year we were at 206 million. The vast majority being in the direct investment portfolio, which Mark will talk about in detail in a moment. But it's pleasing that the second biggest number there was the unrestricted cash that we had at the half year. Some of which we spent since then on the acquisition of FDC, more corporation tax, the dividend to shareholders that we paid late December, and some deferred consideration that we paid to the vendors of the previous acquisition 3 years earlier, which was successful. And this was our sort of 6-month cash flow statement, generating operating cash flow, which is important. We spent 6.4 million in the first half on direct investments, but we also converted 1.4 million as well. So the net was 5.6. And again, a very solid cash position at the end of the period. The last slide really for me is just to talk about what a great share register we've got for a relatively young, small AIM company. And I'm sure you'll recognise all the blue chip names there: BlackRock, Invesco, and others as well. Fidelity. I mean, these are great for a company such as ourselves, a young company, to have these names on our share register is a real vote of confidence. Thank you.
Thank you, Martin. So just a quick canter, if you like, through some of the investment slides. So we see about 2,500 business plans a year across the group and invest in between 3 and 5% of what we see. So that sort of puts things into context a little bit. In this 6-month period that we're reporting on here, 80 businesses invested, but I think really key, 35 are new. We've been selling a lot of businesses in the last 2 to 3 years. So this coming period of 1 to 2 years is about rebuilding the portfolio and regrowing the portfolio. We have sold a lot in these last couple of years. And you can see that from the performance metrics in terms of capital returned, etc. And actually just focusing down on the balance sheet, because of course that's driving net asset value per share. And a question we often get is, are you valuing these businesses at the right value, at the right level? And a great way, actually, 9 years into the journey, is just to look backwards on the ones you sold. Were they sold below the holding value? Were they sold above? Or were they sold on? And so what we've listed here are the businesses that were sold in that context. You can see what the carrying value was, and these are cash realisations. These aren't, we've had paper and something else. These are cash realisations coming through. You can see the premium that's been paid, and I stress premium, so that means those businesses have been going out above the holding value, and I think it's approximately about 15% premium if you sort of add it all up across the group. And then at the bottom here, the things that we've written down and written off in the past. So you can see the context here of the ups and the downs here. And so what this means is, we would argue we're holding it maybe a tad on the prudent side, but we're definitely holding it in the right side of that valuation metric. And that cash generation is what fuels our future investment. If you remember, I talked about the use of the balance sheet and our acquisitions going forward. So the balance sheet is really important in the overall business model that we operate. This is publicly available. It's a list of our direct holdings ordered up in priority of holding value. What you can see from that is just in terms of the values that we hold these businesses at, but how we've moved through that 6-month period, circa 119 million. cash coming in, fair values going up and down and arriving at 132 million in total value. But I think it's also important to look at that very right side, which is the percentage we hold these businesses on. We're typically selling these businesses at 20, 30 to 100 million. And that's why it's important for us to build reasonably big equity stakes in these businesses. If we own 20 or 30%, that's a good chunk of money coming back to us. So we look to build quite large equity stakes through our balance sheet investment, which is complemented through our fund positions as well. All of these have also got fund positions, and the funds are typically taking 10 to 20%. So it's not unusual for us to have 40% plus. We don't control these businesses, but our influence on those is obviously an important part of our active, proactive management process. These are a number of this is our top holdings. So you've got Endreams there, a VR business. And actually, what I won't do is say what they're turning over, because you can do that yourself. You can go to Companies House and you can see what Endreams is turning over. You can see its revenue growth, as with Netaseer, etc. But typically, these businesses are turning over somewhere between 2 million and 10 million at this point, and they are growing as they go forwards. And what's the other point to take away from this is that what we've done with the balance sheet is made sure stage of businesses, we've got young and we've got maturing businesses in here, and sector. So we have businesses across life sciences, we have businesses across advanced materials, we have a real software, gaming, a real blend in terms of portfolio balance from sector and stage. And of course, as I said before, we're selling these businesses. We sold Faradion last year, Oxygen the year before. So we need to rebuild the portfolio as well. So we've added 3 businesses. Axis Spine, which is also held in our EIS funds, is a spinal implant business. We've got Nova Pangea, looking at biochar and looking at biofuel as well in the aviation industry. That's across regional funds, our EIS, as well as the balance sheet. And Unify, again, regional funds and the balance sheet, and that's curved surfaces in terms of interactive motion and movement sensors. And that, again, has got a sort of automotive application, actually, a really interesting business, earlier in its stage of development, but quite an exciting one in its own right. Oh, 5 minutes early. Excellent. Sorry, I'm smiling slightly because I'm always told off for going over. So just in conclusion, leaves plenty of time for questions to Martin. It's an earnings enhancing business, yeah? So the acquisition of FDC was earnings enhancing. All of our acquisitions have been earnings enhancing. That's a really important metric to our acquiring in that regard. And it provides a further national footprint. Our focus is the UK. We look at how we build that footprint out. It moves us closer to a 2020 vision. We talked about our 2020 vision. Part of that was growing assets under management, and it was actually reaching quite an ambitious 1.6 billion target from a circa 900, 1 billion now nearly 2 years ago. We believe we're going to get onto that journey. That 1.6 billion we think is eminently achievable. I've talked about the long-dated funds. I think it's really important with us. We don't invest in listed securities, but we've got a number that have moved on to the public markets, if you like, but we do not have a focus on public securities. Therefore, redemptions, etc., is not something that happens within the funds we manage. The group, I hope you agree with me, with nearly a third of its assets under management in cash, is a highly liquid business. We have ample cash to build and take advantage of opportunities as they're presented coming forwards. The fee margin on those funds is approximately 2% blended across the group. So again, a very robust fee margin in terms of our third-party funds. And I keep going on about the liquidity, but the most important thing here is it's a liquidity across everything. So across our venture, across our private equity, and across our debt. So that means in all assets we manage, there's ample opportunity to rebuild the portfolio and to strengthen the existing portfolio. Thank you ever so much for your attention.
Questions from the floor? This gentleman here, please. Thank you.
Good evening. My name's Michael Adams. I am a shareholder. I'm interested in the valuation of your shares on the stock market, which are at a huge discount compared to your net asset values. Do you recognize that these dealers might actually be undervaluing the share, taking into account the huge premium you made on the disposal of the businesses which you acquired in the past?
Yeah, I mean, yeah. So you know, the underlying point in that is the share price undervalued or not, and there's not a chief exec on the planet that wouldn't stand up before you and say the share price is undervalued. So I will keep with that chief exec line. But I mean, fundamentally, what Martin and I, Julian, who's the CIO, doing is we're focused on building value with the expectation that the share price will catch up with that value. We promised the city that we would take this, when we first started this journey, this highly loss-making small fund management business through to a cash-generative, profitable, dividend-paying business, and we've done that, and we will continue to do that. And the same with the NAV per share. We're growing that, and we will continue to do that. So that's what we can control. I can't control the share price.
Yeah, and I think in the small sector that we exist in on the public markets, and it is deeply frustrating, and you can look in the annual report at how many shares we each have in Mercia. So we definitely have skin in the game. So our share price, for example, this year to date, is down 13%, which is frustrating, but the whole market is down. If you look at our comparators, Augmentum FinTech is down 31% this year. IP Group is down 36%. Molten Ventures is down 54%. And Forward Partners is down 60%. And that's the last 12 months. So although it is deeply frustrating for all of us as shareholders, I suppose the only comfort we can take is that our share price has suffered the least. And our discount to NAV, if you have a look, is also the least worst discount to NAV in our sector.
Thank you. This gentleman here. Go on, sir.
Hello. The asset managers that you just mentioned, are they competitors?
So I don't ever see competition. It's back to the syndication piece. So I see them as syndicate investors. So we might choose to invest in their deals. We see 60 to 70% of all deals that come out there. So we see a majority of the deals coming through, but we don't lose deals to them. So we haven't lost deals to those, but we may in the future co-invest with them, and we have one or two co-investments with them.
My question is actually attempting really to understand the structure of Mercia compared with other asset managers. Is there another asset manager, for instance, well known that is similar to yours, like Ashmore? Is that similar?
Canaccord recently did a panel where they invited what they thought were similar asset management businesses together. And there's a business which is materially larger than us, is probably the closest, which is called Intermediate Capital. And that has its balance sheet in a fund management operation. So there's not many of us that have checked. You get sort of listed trust funds, or you get third-party fund managers. There are not many where they've managed to develop a model where you can interlink those two. And that's something that, although we've been on the market since 2014, we've been developing this since 2000. So this has been a model that's taken quite a few years to get right and to get it to fit right. And now we're just scaling it.
Thank you.
Thank you. Any other questions? This gentleman here, please. Lisa, thank you.
Hello. Yes, just 3 small questions about Brexit advantages and disadvantages for you. Increased tax rate cons and default rates of your companies.
So I'll take one of those, and I'll probably lean on Martin for the other 2. I think in terms of Brexit, almost the jury is out. Let's see what happens with the Windsor framework and state aid. So I think for me that's the critical thing there, because if state aid changes and the flexibility of that change falls down into EIS and VCT in particular, what you can do with that capital broadens out the market, which I think is really exciting. So if you don't mind, I'm going to say the jury is out on Brexit. It had an immediate impact in terms of our portfolio, but what we're very good at, because of our closeness with the portfolio, we did it with Martin and I have spent all weekend on the Silicon Valley Bank piece, is that we go straight into our portfolio to find out what the challenges are. And with Brexit, we had a lot of activity in that in terms of actually internationalising the businesses. So ironically, our portfolio became global because of Brexit, because they were actually selling into Europe quite extensively. But I think for Mercia as a house, the state aid changes could be pretty positive if they come and if they are delivered.
Was the question on tax rates, did you say?
Increasing
Increasing tax rates?
Yeah.
Yeah, so...
Upcoming.
Upcoming, yeah. So we currently pay 19% corporation tax on our taxable profits. I'll come back to that. And unless there's a change in the budget, then it's going up to 25%.
Yeah.
What I would say about our model is that most of the assets on the balance sheet that you've seen, the investments, qualify for something called substantial shareholder exemption. I won't bore you with it all. But if those investments do qualify, when you sell them, if you make a profit again, there is no tax to pay. So that's another good element of our model, which is that although on our trading profit, in a sense, we'll pay corporation tax because we've used up all our historic tax losses, for most of the things that we sell at a profit, we don't have to pay tax on that profit.
Thanks, Martin. Patel, that gentleman there. Go on, sir.
Hi. You're getting close to answering two of my questions. One is about your fees. You said 2%, but 2% of what? Please just tell us more how you make your money. And the other one is how you... I know nothing about your company until I came today. So sell me it. I'm invested in things like Forward and Moulton and Harbour Vest and all the rest of them. They're trading at, near 50% discounts, blah, blah, blah. But differentiate yourself. Why would I want another one? Why would I want you?
No, not another one. You might want an instead of.
I'll let Martin cover the fee piece off, and then I'll do the pitch.
Yes. Yeah.
Well, I'll do the pitch then. So why Mercia? And I think the differentiated model here is that balance sheet does not go in both feet into the risk agenda. Yeah. So most of our businesses that we invest in the balance sheet, we have lived within the funds for a number of years, sometimes 5, 6, 7 years before we invest and co-invest with the funds. And then we take the risk element of that for the funds because we're bringing in scale-up capital to those businesses. And so that works extremely well. We syndicate within the group. So we are looking at complementary fit in terms of expertise. There's 140, 150 people within Mercia. A number of them have grown their own businesses, a number of them got deep sector experience, and a lot of them have a deep investment experience. So why Mercia? We are the biggest in terms of breadth of reach for deal origination, and the balance sheet's risk exposure, which really speaks back to what you can see in terms of its performance, is much more limited. So it looks more private equity than venture, even though they're venture assets.
Okay.
Yeah, and also, and then to come on to fees, which is why we've built our funds under management piece, is that I think you'll find we're the only one of that cohort who is profitable on a trading basis. Because the revenues and profits that we generate from our fund management activities cover the costs of the PLC and cover the costs of our balance sheet investment team as well. And that blend of the profitability of the fund management operation and the skill set of the balance sheet investing is what differentiates Mercia from the other companies in the cohort.
Would you buy 100% of a company?
Would we? No, we would not.
And we have not.
No.
So.
Do you mean as an investment? Yeah, no. No, because for all sorts of reasons, one of which we'd have to consolidate their results into ours. But we never want control. We never seek to control the investments that we make. We only influence their direction of travel.
If I could, I know this is, just want to add to that because it's a really important point, is our approach is we build out the management teams. We have a central resource within Mercia that does executive searches, etc. So we would much rather build out the team, Endream's made an acquisition just recently, and finance that business to go and acquire businesses than for us to go and acquire them.
Thank you, Martin. Thank you, Mark.